Hello everyone and welcome to Al-Hashel Hall at Boursa Kuwait. My name is Amina Abu Talaf, President of the CFA Society Kuwait. Since our establishment in 2008, we have been dedicated to raising standards within the investment management industry. And we also contribute to the professional development of investment professionals in Kuwait. Today, we are honored to be working closely with Boursa Kuwait to achieve that. This week marks the 6th annual World Investor Week, a week-long global campaign to raise awareness about the importance of investor education and protection. Boursa Kuwait has been participating in this initiative for the past 2 years, shedding the light on different topics through a series of events to raise investor awareness and improve financial literacy. The Society has been a proud partner of the exchange, contributing to the Boursa Academy online platform and hosting a series of events of which I am happy to see you all participating in today. Today we have Dr. Badr Al-Hashel, our guest speaker. He's an Associate Professor of Finance and Financial Institutions at Kuwait University. He will be talking to you today about the future of risk and the challenges we can see in this field in the coming years. Dr. Al-Hashel received his PhD in Finance from Indiana University, Bloomington, where he also received his MBA and his Master's in Business. His research has been internationally published in many internationally recognized journals, focusing on corporate governance and investments. He is also a CFA charter holder. Thank you all, and please, again, welcome Dr. Badr Al-Hashel.
Jazakum Allah bil khair jamia, and good evening, everyone. I'd like to say, thank you very much for Boursa Kuwait and the CFA Society for this invitation. I'm really happy to be here today. It's a real privilege. Some of the faces I see in the crowds are people I know that work in the financial industry. This is obviously directed to those especially. And I see people who work more into financial risk. Maybe I'll disappoint you because we now have a very good grasp, I'd like to think, on financial risks. So this will not be the major side of things. If you think a lot about credit risk, market risk, there's a lot of tools that have been built up over 70, 80, 90 years of the financial industry where good knowledge has been built up. I know you'll think, well, there was the global financial crisis in 2008. That was a financial risk indeed, but still, nevertheless, there is a lot of good, grasp on things. So this is, I guess, what I'm trying to say is risk management is no longer what people used to think 20 years ago. The risk landscape has changed a lot. 20 years ago, if you talk to regulators, central banks, they'll be worried about leveraged balance sheets of banks. They'll be worried about credit. Nowadays, if you go and talk to a regulator, that will not be the top risk that's on their mind. They think about different types of risks that have evolved over time because of how we do things differently. Digitization, apps, connectedness, all of these things have changed things. But nevertheless, this has also allowed us new opportunities and challenges, in the sense that because there are different risks, and these risks emanated from different changes, digitization, better measurements, etc., we're also able to measure a lot of risks better than what we were doing before. And hence, if you can measure risk, you can know how much risk you're taking. Is it a calculated risk? And maybe tie it better to performance. Point number 3 is that because you're able now because of these changes, there are opportunities for leaders in various institutions to think more about risk-return relationships. A concept lots of people did not think about previously. Yes, I know everybody say, no, take more risk and get a return. Obviously, this is not the right formula because if you took more risk, it's a more expected return. But the idea is that when you start being able to measure risk, you can start thinking about how better to deploy your assets. And we'll get back to this. For example, a concept that's more common nowadays in banking sector is return on capital. So regulators require you to allocate capital to various assets and exposures. CMA now has applied the same for investment companies. So you want to understand how much return am I getting for this amount of capital? Is it being deployed properly or not? And then obviously there is bad threats. So some of the risks will be there. Some of the risks you'll be able to manage. There are risks that you will remain forever unknown to you until they hit. I guess 2 years back, nobody in Kuwait would ever thought that there's a pandemic risk. It hit us big, and the disruption it caused was unprecedented. So maybe now all of us think about pandemic risk and take various initiatives to, mitigate that. Most likely the next big hit will be coming from something that we don't recognize or are unprepared properly for. So does risk mean bad things? This is actually the very old way of thinking, especially in banks, where the risk function used to be an old function relative to other areas. It's always thought about as bad guys. They're the guys who try to stop things. But you need to think about risk and the risk management people more as, performance enablers. Those are the people that support the institution. They're not there to derail your performance. They're not there to derail your growth. They're actually there to help you understand what are the pitfalls ahead of you and how you can manage these pitfalls to achieve better performance. So you need to start thinking that risk is healthy, because you actually need to take risks. But the idea is you need to take calculated risks. You need to take risks you understand to enhance the value of the institution and enhance your performance. So what are the top risks? So if you think, what are the top risks that are focused, and you talk to a lot of regulators, bank regulators, investment company regulators, risk management professionals, as I said, you'll not find, unfortunately, credit there anymore. Market is no longer very much a worry for a lot of people. It's things like systems and data security. You don't want to have a data breach, for example. And we have a very good, I think, example here in Kuwait. One of the banks a few years back had a significant leakage of credit card information. Disaster and crisis response. Think COVID. Okay, you want to be in a place, where you think about these things. And nowadays, I think telecommunications were quite a bit good on this. They always had concept of business continuity. So the concept of business continuity needs to be there in the mind. Regulatory changes and compliance. So you walk in one day and you're working in a bank here in Kuwait, and then you get a nice letter from the central bank that says, well, we decided to change the regulation. Suddenly you're hit on a certain dimension, be it liquidity, maybe you're hit on your capital requirements and now you need more capital. Maybe you're hit on other requirements, cybersecurity, etc. And now you need to invest more. Macroeconomic and geopolitical risks. These are things, again, you wouldn't necessarily think about, but Qatar would be a very good example of what happened and the ramifications. How would that impact businesses in Kuwait? What if you had exposure to Qatar and the embargo, etc.? What if you were, maybe not a lot of people care about this, but what about if you had exposure to Ukraine? All of these geopolitical risks matter to you. Digitization. So the more you move into digital, it presents a lot of different risks. So if you are a bank and you are very proud of your app, what would you be worried about? That the app fails. People try to log in and the app does not allow people to log in. That's a significant halt to your service and products, and you want to ensure that you have robust infrastructure to allow that not to happen. Supply chain and outsourcing. So this is also new things as we rely more on vendors, consultants, outsourcing, suppliers. Imagine you're a broker in Kuwait and you've outsourced a certain part of your brokerage platform to another company. So you don't manage the platform, you just have your nice logo on it, on the web page. And on that day, the platform, the brokerage platform is not working. Your third-party vendor is not working. What's worse? So we're at quarter end. Banks are submitting their report to the central bank. Everybody else is submitting whatever they have to CMA. You come into the office, it's the first of the quarter, and your core banking system, your core systems are down, and they can't be fixed in 1 hour or 2 hours, and you need to talk to the vendor, etc. That causes a lot of disruption, not only to your services, but many of your requirements. Capital, I guess liquidity and financing, it's still there, but it's not as big as it's used to be. Okay, so you worry about your liquidity, but there are various tools that help you manage, and you can understand corporate governance. Are you applying the, proper governance systems? Are you ensuring that proper controls are in place? Human capital and talent management. As people become more and more critical within the processes in your institutions, losing them is a huge risk. So if you think about Kuwait Clearing Company, there's a lot of manpower and human capital in that company. If certain people decided to leave, can that company, which has a very crucial role to play on a daily basis in Kuwait's economy, can that be sustained or not? So you want to be sure that you maintain talent, grow talent, and have ability to continue. Management and reputation, and we'll touch back later on during the talk today about that dimension. So I want to focus on, cybersecurity. It's something that we didn't think about 10, 20 years ago. Nobody would have thought about cybersecurity, but it's a huge, huge issue. And I'll tell you why cybersecurity is important. 2 incidents within 3-year time frame here in Kuwait, very popular incidents. The first is bank. 2019, they get hit with a hack. The hacker is able to transfer 20 million KD. Lucky they were able to recover roughly 17 million. 3 million was never recovered. They could never track it. Another incident is data breach, which happened with bank on credit cards. That's also another. The third one happened a few months back. I don't know if anybody noticed, but commercial real estate had a significant amount of money lost, I think north of 5 million KD, because they had a hack. So the hacker, what they tend to do, it's not, the kind of what you see in movies. These are people that will go into your system and will stay there for a very long time, monitor what's happening, and understand your organization, and then decide to take action. So this hacker understood who had the authority within that company to ask for money transfers. He also understood where the money was and who was the responsible person in the corresponding bank to receive that instruction. So an email was sent from that person's email address in a very good language that resembled the language of that person. So they'll not write, you'll not see the emails which you tend to get from random people in Zimbabwe saying that you've inherited 10 million KD or whatever. No, it will be very well written in similar language that person is accustomed to, and it was sent to bank. Okay, all of this is public information. It was announced on the Boursa, and the World Bank executed the transfer, and commercial real estate lost 5 million. I don't know if they've been able to recover this or not, but these are examples of cybersecurity. It's a big hit, and it's unexpected. You didn't account for it, and it really hurts the bottom line. And data security, imagine that you've lost not just a bank, a hospital in Kuwait, and you have very private information about people's health, and that gets breached. How will people trust you again with their health and their private information? We talked about regulatory change. I think, for example, investment companies, a few years back, or not few, I think last year, was when CMA decided to apply capital requirements and gave them 1 year to comply. So now a lot of companies had to figure out a way to accommodate those requirements. That's a risk because you never know what could happen. Central bank had some, for example, I recall back in 2019, they had some risk weight calculations for banks and capital adequacy. They decided to change those, and that was an immediate hit to the banks. So you never know what could change, and it could be not just the regulator. Maybe it's the Ministry of, I don't know, someone had the Shu'un, Social Affairs. They decide that they will not give 60 plus people of age any more permits to work in Kuwait. You're not a bank, but you're some kind of a business where you rely a lot on people in that age segment. Suddenly now you're hit and you have to take out a lot of your workforce, and it's not easily replaceable. We talked about digitization. One of the things people now care about is sustainability. I know most of us here in Kuwait might think this is like a cliche and, et cetera, et cetera. But if you are an institution here in Kuwait and you try to go outside of Kuwait, that will be a big hurdle for you when you deal with international stakeholders. If you want to raise capital, if you want to raise debt instruments, for example, if you want to issue any form of bonds, sukuk in the international financial market, they'll ask you a lot. What are you doing on the sustainability front? How are you contributing there? So this has become a risk if it's not managed properly for your institution. If you are a major institution, for example, institutions like NBK, I'm guessing AUB banks that have KFH, that have a lot of international branches, especially those in developed market like the UK, the regulator there will also require your operations in that country to adhere to certain requirements in terms of sustainability. So, and there was this guy a few days, they were talking about cybersecurity and the budget, etc. And someone said, like, yeah, we need to get money for some protection on the cybersecurity front. And what the head of that department said, that if actually we get hit with a hack, that budget will be untouched because most likely we will not be there. We will be fired. So if you talk to a lot of people in risk management, cybersecurity has become like the thing on their minds. So I think like even the, can't remember, but there was a talk, the governor central bank pre-COVID, maybe he was also asked what boggles, what keeps you up at night. I think cybersecurity was the thing. The central bank would be worried if there was a big hack in the system. And this is why the central bank has required banks to adhere to a lot of frameworks, requirements, all kind of stuff they do on that front. So risk management nowadays has to go into kind of a concept where it's vigilant and resilient. Vigilant means you're always on the lookout for incremental levels of risk, always trying to understand and measure what's out there. You'll never capture everything, but you need to just, keep your eyes open and understand what are the possible risks. Resilient is being able to observe the shock. I think the best example of this is when COVID hit, there were a lot of businesses that were able to get up and running within a month to two. And there were businesses and corporations that were never able to open up until maybe July, August, since March when the not the quarantine, but the lockdown happened. The difference is they were hit with the same level of risk. You are now required to close down. You need to halt your business. Some were able to observe the condition and continue to perform, and others weren't. Some were able to adapt better. I remember, as small as certain, for example, if you look at the food industry, suddenly you had a lot of small players that you would never think about, but they were very smart in detecting that this could take some time, and they immediately shifted not just to delivery, but to selling their products in the supermarkets and the co-ops. That tells you about a resilient business framework as opposed to someone who got stuck in what they're doing, and many of them ended up closing shop. So you need to monitor your emerging threats. You need to have a framework. And what's nice nowadays is that if you're moving towards digital, then that means you have a better way of collecting data. Better ways of collecting data means you have a better chance of monitoring how things are changing and developing. So you need to keep an eye out. And data is your friend to understand what's happening. You need to identify the anomalies. If things are weird, if things are changing, what's happening there? One of the, for example, interesting things I think some people are now doing in terms of risk management is that on the credit front, is they no longer wait for the financials. They no longer wait for you to submit the P&Ds, etc. They actually monitor your accounts. So if you have operating accounts within that bank, they'll monitor the operating account, and hence they will know if you are having a slowdown in your business. And accordingly, they will take preemptive action to sit down and understand what's happening with you. Because if you think about it, except for public companies which tend to issue their financials within a 3-month time period, private companies have no requirements to do that, and some will issue their financials in June, July, August, 8 months after year end. If you look at them, the information is already too old and wouldn't tell you much. So you want to start using that and leveraging that data. You want to, as we talked, worry about your vendors. It's as you rely more on vendors, it's really important that they have in place an ability to support your business and ensure that they don't have data breaches at their end, business continuity, etc. Workplace disruptions, COVID is a good example of that, and you never know. You could have various other things where people are not able to get to work, war, etc. All of that could cause challenges. So use data and benefit from that, leverage what you have, set up people that works in analytic frameworks. So there's a lot of, growth in that area, a lot of learning and development that can happen where you utilize people with significant level of data analytics, machine learning, AI. So if you're a mathematician, statistician, engineer, I know these are fancy words, but basically machine learning is just a simple regression. Y equals A plus BX. But because, some people like to use the fancy words, but just basically start using that data, build relationships, correlations, understand what's happening. That will allow you to better understand the landscape in which you're operating. For example, if you monitor credit cards and you're a bank, then there's a lot of AI tools that allow you to understand what's happening in terms of fraud on the credit cards. So you can detect fraud early on and avoid buildup of losses on the credit card front. And sometimes there's just, you're in a position where resiliency might not be easy. So you need to think about that. You have a certain process, a reliance on multiple entities, stakeholders, steps that are hindering your ability to quickly or appropriately respond, or a better description, a more agile word of responding to crises. Risk transfer. So there are various risks, and what you can do is sometimes there are risks that you want to observe, but there are also sometimes risks you want to transfer. And the best people that are willing to accept a risk transfer are financial institutions. On top of that is insurance companies. So if you think about the insurance business is people purely buying and selling risk. If you go to an insurer and say, I want life insurance, they're basically buying the risk of you dying early. If you go and buy insurance on your car, they're taking the risk. You're transferring the risk. So if you having to pay the bill of fixing your car, you're transferring the risks to them. What's a good example? I'll go back to bank. If you go and read that announcement, they'll say, we got hit, we lost 20 million, we recovered 17, 3 million roughly was never recovered. However, based on our insurance contract, we might be able to recover that through the insurance contract. So banks have something called banker's blanket bond. So they go and buy very unique insurance contracts where they get covered on a lot of operational cyber aspects. These are risks they cannot easily protect themselves from. So what do? They transfer them to big insurance players. It won't be someone usually small. It will be a mega insurance player on the global market. They'll know how to price these things. They will look at the processes, the policies, the control within the institution, and then say, okay, this is how we will price the transfer of this risk. So Gulf Bank would go to that insurer, tell him we lost 3 million KD, let's get a reimbursement. They'll go through a process, due diligence with the insurer, they're called loss adjuster, etc. Then they'll say, okay, we'll compensate you for X or Y or Z. Maybe they'll cover the loss fully, but that helps mitigate some of the losses. And the problem is it's those kind of instruments, risk transfer, is very good for these kind of incidents. The mega impact incident where they have a material hit on the bottom line. This would also include things like internal fraud, etc. So the risk transfer, you have a lot of instruments. You have the insurance contracts. A lot of people would transfer risk through derivatives. For example, credit default swaps are very kind of globally traded instruments. You have an exposure with obligor X, company X. You have an exposure to country Y. You no longer want that exposure. You can enter into a swap, but you cannot sell the exposure. You enter into a swap that will compensate you if that entity defaults. You can go into all kind of options. So nowadays, I think there's also even weather options. So you can buy an option on whether it will rain on that specific day in New York City. And you think, why would anyone want to buy something like that? But for people that are operating, for example, in the logistics, transportation industry, any disruption because of due to weather could have a lot of losses and costs to them. So they want to get into these contracts to offset some of the losses that they would accrue. So it helps you manage these risks, the mega impact. You can also design sometime risk-sharing agreements. Not easy, but you can, for example, when you work with someone, a JV partner, etc., you say, we will share the risk, and therefore, if this works out, we both get the benefits, but if something goes south, you'll be part of the agreement and you'll share with us some of the burden and the loss. But the problem is it's not easy to have risk-sharing agreements. Like imagine suddenly you tell consultants, I will listen to what you're saying, but if this doesn't work out, we will take a cut back from what we already paid you. Wouldn't sound very lucrative to the consultancy industry, but it actually aligns them better to your performance. Sometimes there are risks that are not easy to price. Or you're over-insuring. So you take out insurance on every single thing. And hence you've added a lot of cost and burden on you that have diluted for you the potential to earn better returns. We're good on time? Okay. What I'd like to think is go back to that earlier point about risk as a performance enabler. So if you better understand risk and better measure it, then you can actually use that information to take calculated risks and do better risk-adjusted performance. If you have, so in the old sense, or in the old days, if you had a good CFO, he most likely would have told you, okay, we're taking, we make X in this department, we get Y from this department and Z from this department. Obviously, if X makes the most profit, then that's the greatest place for us to be in. But it's very likely that X makes, for example, the greatest amount of KD profits because it's where you're taking the most of risk. And hence, you need to measure the relationship between risk and return. I remember like the fund managers, equity fund managers, would always get pissed off if you tell them that your performance is you need to think about your performance. He says, no, I got 30% return this year. S&P was up 10%, or Boursa Kuwait was up, Premier Market Index was up 5%, and I got 20%. But the question is, how much risk were you taking in that portfolio? Were you really trading in the premier market share, or were you operating more into different kind of segment? Did you have concentration? So by understanding better the risk relative to the return achieved, you're able to better determine who's giving you a better bang for your buck. Who's really worth the money that they're being spent? Who are better able to enhance the value? Who are better able to give you a higher NPV? And this is really matters, for example, again, banks nowadays think a lot about risk-adjusted return on capital. And efficient institutions will allocate capital towards departments, functions, areas that are better able to get a higher return on that capital. So you might realize that, well, we've been giving a lot of money to Department X, but actually it's Department Y that actually could get more capital and achieve a better return. So you kind of optimize where your money is going. The same can be thought about nowadays with investment companies and the CMA capital requirements that will allow you to rethink, do we need to keep some of those assets or just leave them out? It actually can help you know, are we taking enough risk? So maybe you're not taking risk as a company. Maybe the amount of risk you're taking is small. You're getting a good return, you're getting value added, but maybe it's time for you to think that your risk appetite is bigger and you shoot for higher. So by understanding the risks, you are better able to know how much risk should you take. Maybe you were taking too low of a risk. And you want to, emphasize a risk culture. A risk culture is where people understand what they're doing, understand the risks they're taking, and how better to manage them, and how these risks are taken in a calculated way to enhance returns. The new concept is now, if you have the concept of 3 lines of defense against risks, the first line of defense are the risk takers. They are the ones that they need to think about the actions they're taking and determine if they are really appropriate for the institution or not. It's, by the time it gets to internal audit, these guys are the 3rd line of defense. They would only most likely see it after a good time lapse. And hence, you want unnecessary risks to be stopped, most likely there, not at the 3rd line of defense. And yeah, one last thing I want to mention when talking about measuring risk is that the concept of risk dashboards, risk appetite, it's really important. One of the interesting banks in Kuwait, the CRO, when he first showed up, he decided that I'm not going to rely on IT or some other department to give me data. I'm going to build my own data infrastructure. I'm going to connect it through the core banking database, and I'm going to be able to see within the tip of my finger where do we stand as a bank in terms of various risk measures and exposures. And that enhanced the ability to take decisions. Significantly enhanced the ability to support the business and enable it, monitoring these risks, understanding that there was no sudden, buildup of risks and exposures, no hidden bombs that someone forgot or didn't want to share. Risk was very well in many dimensions, not everything obviously, but in many dimensions. So having risk dashboards, risk appetites, where you discuss, for example, with the board, with the top management, how much level of risk they're willing to take, helps a lot to enhance the performance. Last but not least, reputation risk. This is something that was not much around 20 years ago. But nowadays, with all of these guys on the left, people being much more connected, information much easily spread, worry about reputation and being able to observe that risk is really important. I think the worst example I have in mind is about 15 years ago, someone in Domino's Pizza in the US, there were a bunch of young people working in that store. They decided to film themselves, and I think it was YouTube was just getting there, and they went and decided to, sorry for the description, but spit in the pizza, close it, and deliver the pizza, and they went and shared that on YouTube. Imagine the impact on the company. How would people now trust that your pizza is clean? Think about that example, and then think about the multitude of events that could happen nowadays. If you walk into a branch in a bank and someone is inappropriately treated, most likely there's someone holding their phone, taking a video of that incident, and will definitely post it somewhere. And suddenly that video will go viral and you're hit in terms of reputation. And that reputation damage could take some time. I think Domino's Pizza got really hit. They had to spend a lot of time to get back on their feet. They had to spend a lot of money to convince people, not just from a marketing perspective. They had to go and install cameras, a lot of training, etc., people screening to make sure this doesn't happen again. And I'm sure a lot of people were not happy at the beginning with all of that money that got spent. So reputation risk is now something of importance. You need to have capabilities to deal with that on different levels. For example, crisis management. Do you have a team who understand how to deal with a crisis? How to put the proper message to the audience, to your customers, to your stakeholders about what happened? Do you have good ways of managing the level? So certain companies nowadays in Kuwait, they will have tools that monitor the tone of people when they mention the company's name, or they mention the company's tag or whatever, the user ID in Twitter. So they know what's the tone of the people towards their brand and where are they? Are the words being used positive words or are they negative words? And then therefore they can treat the brand equity and work with people. So you try to work with your employees on how they need to behave themselves. And also very important, whenever these events, if you go, for example, and check the tag for any bank, the user ID, and you look at what people are saying, you'll notice a lot of people complaining. It's like this is happening, this is not happening. Someone will mention the CEO and say, I'm stuck in the branch. Does the CEO have to go and respond, even if he had the time, to every single mention? That might not be the proper action, because you never know how serious what's being mentioned. So investigate, understand, and then take the proper action to deal with situations like these. So just to recap, what are the, where does the future of risk lie? The future of risk lies on us being better able to measure the risk. We'll never understand everything, but being resilient and able to observe some of the shocks. Cyber, operational, fraud, all of these now are top risks that people need to be worried about and be prepared that there are the proper controls to protect the institution against this. And we've heard a lot of stories, for example, here in Kuwait, about fraud committed in branches, someone stealing from clients, all of that. You need to think about how you're dealing with these things and start changing the mentality towards a risk enabler instead of a risk, hinderer kind of a concept within the institution. I know I'm a bit ahead of time, but أعتقد هم صلاة المغرب يعني. Thank you all again, for taking the time to come to me. I know everybody came most likely from their office, so I really appreciate that. I hope that my 60 minutes of talk were worth it. Any? Yeah, of course. So I just want to say the thank you first before I forget the Q&A. So really thanks a lot. I'd love to thank Boursa and the CFA for the invitation, and feel free to shoot whatever questions you have in mind.
From the external risk environment, aside from the internal risk, today we're seeing a lot of factors, the geopolitical and Russia. Oh, sorry. Do I have to say this all over again? ولا كمل?
No, I was good.
From the external risk factors, in terms of, we're seeing a lot of geopolitical risks, طبعا economic, inflation, recession, what the Fed is doing, what other countries are doing. There's a lot of things going on. how do you rank, in your view, from what you're seeing, how do you rank those risks, and what should institutions do to respond to those risks? خاصة يمكن من منظورنا from being in Kuwait, we're a little bit insulated, yet we are exposed. So how should we respond, and how should we prioritize those external risks?
Very good question indeed. Thank you, Mr. Taab. I think it's one of those there. It's up there. I think the answer to this question is that, as I said at the beginning, there are risks. We have gotten a good handle of how to think about, how to tackle, and there are the risks which are yet to be able to measure and understand, and the hits tend to be really bad. So the macroeconomic risks are not risks that we can 100% control, 100% mitigate. No, they're definitely there, and they'll always hit us. But the good thing is we have relative to other risks, better understanding of. So when we talk about inflation, so inflation is a much bigger risk, for example, in the US and Europe than in Kuwait. So that's kind of mitigated. The worry that many have is interest rate and how the interest rate environment is increasing. And because in Kuwait, the economy is not doing great, we are seeing unprecedented moves from the monetary policy sense. So that obviously presents a risk. The first risk that comes to mind, if you're a normal company, that discount rate will go up and it creates an additional burden. So how do you deal with that? You have various ways to mitigate. Maybe you reduce your lines of debt if that's possible. Maybe you reconsider, maybe you restructure. And then there's banks and how they took default risk could go up, profitability could be hit, and you start thinking about that. But for example, one of the tools we have is that because there's a huge derivatives market, we know that the market, what interest rates hikes are priced in, at least in the US. We can't predict what Kuwait's central bank are going to do, but we got a good hint of things. And you can start thinking of, well, if I'm going to protect my balance sheet and protect my profitability, what am I going to do? Well, I need to start thinking about my assets and liabilities. If interest rates are rising, do I want to lock rates in? Do I want to move into assets that are more floating rate, that kind? Or if you're worried about the default risk because interest rates are hiking, then you need to, for example, take a preemptive action and think, well, okay, so who's most vulnerable to these interest rate hikes? Who has the weakest ability to service the debt? And then you start having those and you sit down with them and say, okay, you guys, we think we're worried about you. How's your business performing? How are you being prepared to absorb some of the additional debt burden that will build up? I hope that kind of answers your question. But there's always, obviously, if oil decides to drop in prices and we have another fiscal crisis, there are things that you'll not be able to mitigate unless you decide to close shop and move out.
Thank you very much, Dr. Badr, for this eye-opening overview on the future of risk. This is Ali Al-Khalid, Head of Cybersecurity and Business Continuity at CBK, the Central Bank of Kuwait. Just commenting on the exposure of Ukraine and Russia war from an operational point of view, we have supply chain risk, which is in fact we are fully dependent on the technology vendors in the EU area, on cloud service providers in the EU area, which is a target for Russia, being a hacking nation, one of the nations that are basically have almost the highest capabilities in the world. So we have a supply chain issue. Supply chain risk. Also, cybersecurity. When it comes to allies, when you are on which side you are with Ukraine or with Russia. If you are with Ukraine, then you are a target, and you see it in the so this is just from an operational point of view, يعني apart from اللي هو financial risk. I have a question and I have an observation on the lecture itself. Now, clearly we are shifting from as you have clearly indicated, إن إحنا financial risk is well understood. We are moving into other types of risk that are new to us when it comes to analysis and هذا. One of the key issues that we are facing as an organization and as a regulator as well is the quantification of risk. Now, financial risk, liquidity risk, and market risk, whatever has a financial dimension, can be easily quantified, can be easily modeled, can be easily analyzed. When you go to operations, it's another ballgame. It's not as easy as it might be shown, especially cyber risk, which basically opens up the question for insurance. Now, even insurers, they want to quantify risks when it comes to cyber incidents, and it's not easy. It's not easy. Here in Kuwait, we are talking about insurers who have a blanket policy. They very barely touch the problem when it comes to reimbursement or. So I just want to hear your perspective, Doctor, on the quantification angle of risk when it comes from financial risk to operational risk. What are the advice, what are the insights in this regard? Because this is a very important point.
Jazakallah khair. I guess this is what, I think you touched a very interesting dimension. If you take liquidity risk, there's a lot of measures nowadays adopted by the Central Bank of Kuwait, international standards on how to measure liquidity risk. And then you'll say, well, this is acceptable risk for me. I'm taking excessive levels of risk. The same can be said of market, etc. But we are far, far out in terms of the other risks, operational, cyber. To the best of my knowledge, there is still no agreed upon quantification methods. Any quantification methods would rely on a lot of subjectivity, where you'd have to make an assessment, well, what's the probability of a hack happening? Okay, an educated guess from someone who works in cybersecurity is you'd bring your head of cybersecurity in a bank and say, well, we've done penetration testing, we've done various tests, so where do we rank? And that person will tell you, well, maybe we're weak, maybe we're good. But it would still carry a lot of subjective assessments. Stress testing has been used for operational risk, where you assume certain things will go awry and see how that will manifest. But still, these domains remain to rely a lot on subjective assessment. And even if you look at the Basel Committee for banking regulation, they've moved back and forth. So they had the standardized model, all banks apply the same operational risk calculation. Then they said, no, we'll do the standardized model, and then they had another model, I forgot what they called, for Basel III. Now for Basel IV, which is going to come out, now they said, no, we think that that wasn't a great idea, having every bank estimate operational risk independently or differently confused a lot of us. We want to go back to standardized models. Everybody estimates the same amount of, or uses the same methodology, because it's definitely a very difficult way to estimate these risks. Sure.
It's always a pleasure نستمع لك دكتور بدر. دكتور عبد الرحمن القريش جامعة الخليج. ممكن تتكلم دكتور بس on the role of insurance companies in Kuwait in controlling the risks that is not financial?
So most of the companies in Kuwait, they do the plain vanilla kind of risks. I could be unaware, but usually if you walk into a normal insurance company, they'll tell you you'll have health, fire, all of that. To my understanding, the banks who use the banker's blanket bond or the banker's insurance, they would have to go to the international market, mostly market in, for example, in the London area, where you have like some of the leading insurance players, Lloyd's, etc., where they are able to utilize those advanced methods, and still there would be a lot of challenge for them to estimate. So it would be very difficult for them to understand a bank in Kuwait, do they have the proper controls in place to mitigate against certain events. So there's a significant amount of challenge, and I think there could be someone in Kuwait, I can't speak for the full insurance industry, this is my very limited knowledge, but to enter into that arena, you would have obviously to build capacity in terms of knowledge and expertise. And even then, and this is normal practice, many of those players would further, use the word, transfer risks another step. So this is why we have the reinsurance industry, and these guys just sit and take the risk of the first insurer. So I don't know if there is, much amount of work in Kuwait that happens on that regard, other than what.
How the absence of that, affecting, Kuwait and the businesses in Kuwait.
I can't answer. But the good thing is, we are no longer, you operate in a global market, so you can always reach out to international players. And what happens, actually, a lot of people, is that even if you speak to a big player in Kuwait, even if they sell you something very sophisticated, which they can sometimes do, there will be someone on the back end. So they'll go to an international player. That player will price the insurance you're taking. They'll quote GIG, for example. GIG will then quote you here in Kuwait and take their spread. You'd think it's GIG that's facing you, but most likely there's another party in the back end. And sometimes they play the role of a broker. They'll actually connect you and then leave the game.
Thank you.
Well, thank you again all for your time. It's a pleasure, and I can't thank you enough.